Okay, so I'm ready when you are.
Okay, yeah, so hey guys, so we have Anthony Scandariato here today. He has a great lecture on multifamily outlook, workforce housing outlook. So as some of you know, he has done a lot of deals in the multifamily space in New Jersey, I think mainly New Jersey, right? And some Pennsylvania, and I think these are the main ones. So it's a very broad, very good experience he has in the multifamily space, and I am extremely interested to hear what he has to say today. So with that, I'm going to pass it on to him, and looking forward.
Great. Thanks so much again. We really appreciate you having me, and thanks everybody for taking got muted. We'll get started right away. So basically the format that I like to take, if I was in person, I would literally just give the presentation, have people stop me, but because we're on Zoom, I'll just give it, and then, we'll have an open discussion from there, if that works for everybody. So with that being said, I'm going to pull up my PowerPoint and also close my email so it's not pinging every 2 seconds. So I will share my screen now. And let's get started. All right. Everybody see? Stefan, can everybody see?
Yeah, it's perfect. So it's in full screen.
Perfect. Awesome. All right. So with that being said, I want to start this presentation out with saying, we have a housing crisis in this nation. So everybody's very concerned about the potential election that's about to come up and how that's going to affect the economy. Understandably so, in either direction. But the fundamentals comes down to is that we do have a housing shortage in this country. This is a statistic from the National Association of Apartment Owners. This was updated in May of 2020. They're actually forecasting to predict even more affordable apartments, and I'll get into what is defined as an affordable apartment a little bit later. Having a shortage in the general country is actually going to be at least 10% more because of the pandemic, due to, I think I saw a crazy statistic. It was now the pandemic put 2 million more Americans beneath the poverty line. So it's the housing crisis is just going to get, unfortunately worse, but also to, multifamily operators' benefits. So just a little bit about us. I'm sure I know a few of you know about us. My company is Red Knight Properties. I have my partner, Brian Leonard, who is not on the call today, but him and I, we currently own about 264 apartment units. We have some retail as well, some self-storage, all in the tri-state area, New Jersey, New York, Pennsylvania. We're actually about to acquire something in Florida that we're really excited about. And I could kind of explain why we're doing that as well a little bit later on. But I'm sure most of you, have some familiarity with me. If not, used to work at Vision Properties, which was a commercial real estate operator for 6 years, bought Class A office buildings for the firm, and then transitioned into multifamily for a variety of different reasons. We also self-manage our properties as well. So if you guys have any property management questions and collections at the end, I'm happy to answer it. I pretty much know every tenant at the top of my tongue. So when we're talking about, this is a statistic from April, so I just want to put this into context and how, April was definitely the worst month for the United States in terms of coronavirus cases and deaths and the effect that it took on the stock market. And this is basically the lowest apartment collection rate if you took a national average between March and April, according to the National Multifamily Housing Coalition. It was the lowest was 89% at that time. So to me, at that point, obviously unemployment, numbers were trending up. It was only a month of that. And if this statistic took place in April, ever since April, this number's only gone up. It's gone up about a point a month. So for May, it was about 90, June 91, July 92, etc. And this is a national average. So this is the worst point in the crisis that the apartments, specifically workforce housing, which is what we specialize in, was the lowest occupancy rate across the country. So I just want to put that into perspective here. And as we're looking at the U.S. Treasury, and the yield curve as you compare it to last recession and how, there was a fluctuation and how it eventually does bounce back. Obviously, it takes about a decade to do so. I just want to read some notes from actually the keynote that I had today in regards to interest rates and some of my notes. And basically, everybody knows that, the Federal Reserve already stated that, interest rates are definitely going to be low for at least 2 years, potentially 3 years. But history, as you could see, tells us that it's potentially going to last longer. So the Treasury is kind of unlikely to go up materially. And in the event that there's, any negative sort of rates, it's actually encouraging inflation. And without inflation, there's really no, real fear about prices, going through the roof or being, unaffordable anymore. And the bottom line is that, it's, in my opinion, is because the Fed controls LIBOR, it has less control on the Treasury. And, I don't think it will have much of an impact on multifamily. The only thing that, interest rates and cap rates definitely have some sort of correlation. But the way that if we do end up in a deeper recession, I don't really think we had any. The recession happened, in my opinion, in April and May. And then the real recession, once the stimulus kind of burned off, is starting in September. So if this is the real recession where unemployment is, I think I think it's like 8.5%. It's still not great, but it's still better than where we've been in the past. When the rates do eventually rise and if unemployment still stays, around 6 to 8%, then basically, this will be a lending problem. And, the lenders will kind of squeeze the operators with their spreads. So I don't think interest rates are going to go up drastically over the next, regardless of the election, over the next 5 to 10 years. I really don't think so. And the max I could see it going up is maybe 4.5%, 5% for an operator like us. And here's another reason why. So we look at default rates. We use a program called TREP, which I'm sure some of you are familiar with, which analyzes CMBS loans. And they looked at the cumulative default rate with commercial mortgages that will be around 8%, which is, up. And this is only a 12,000 loan survey, so the sample's not huge, but it's still a good amount to sample off of. Cumulative default rate approaching 35% because of lodging and retail. I don't think we've seen the worst with lodging and retail yet. People are currently starting to restructure their loans, trying to restructure leases with everybody. The tenants who are giving the major landlords problems are, major retailers, and we're talking home goods, we're talking very large companies giving major landlords problems. The mom and pops are actually doing okay. But if you look at this, the lodging got hurt the most. Retail is expected to rise, obviously, as well. And the office is kind of still in limbo. I don't think it's going to be as severe, although we still don't know the work for home effects yet. It has, gone up a point as well since April. So as I kind of alluded to before, even with the default rates under the stress test is not great, but it's not going to be bad as 2008, 2009, across the board. Because if you look at industrial multifamily, a very small increase in default rates between, March and where we are now. It's not even 1%. And again, that's over 12,000 sample size, so that's a pretty good sample size. In terms of, rising prices in multifamily, I think the only reason for that, and I can explain that a little bit, we haven't really seen a COVID discount unless you can really negotiate that with the seller. It's just because of the amount of liquidity there is in the market now, because people are on the sidelines and they're chasing yield. And obviously the debt is very driven by that. So for the multifamily and the industrial, as you can see, very low default rates. Lenders are very liquid for them. But the lodging and retail has hurt the most. I kind of just show an example of, how the market tanked in April. We were at 23,000 at that point. I think we were at under 18 at a point, and then it went up to 23, and now we're at almost 27. This was a previous slide. I don't even think this should be on there. But anyway, just to put this into context, is that I think the multifamily investments, it's remaining resilient. There's a lot of market uncertainty still. It's definitely impacted every single asset class. But at the end of the day, it's not purely recession proof, but it does withstand the recession for the same fundamental reasons. It's income producing. It's not as volatile. You can wait out the ups and downs, and historically has always outperformed the stock market and the bond market. So I think the fundamentals are still there, particularly with the multifamily sector. As far as workforce housing goes and the outlook, what we call is the backbone of America, and we invest in a lot of Class B, B minus, C plus properties, which is quote unquote a quality for workforce housing situation, which for us has held up very well during the crisis collection rise. So regardless of their economic conditions, people need a place to live, and we're seeing that. We were just talking before this started, and especially in the suburbs, we're seeing a lot of benefits. I think that the product that's going to be the most attractive are going to be in tertiary markets and in suburban markets, and I can get into a little bit why in a second. But the rentals, the demand for rentals is still extremely strong. The liquidity that's out there is even more, because people are considering these as more core now, and they're not as inclined to invest in the prime Class A products and primary markets, New York City, Chicago, Boston, just to, if we do have more vacancy, if rents have, go down 10%, 20%, there's more investors gravitating towards this type of product. And, fortunately had the foresight to see this before this even happened. But anyway, and the reason why, we really like this is because this is just a chart this is actually based from Texas. And when they were giving out the extra unemployment benefits, this is kind of, what we're looking at. And even if, since the $600 has stepped off, we're still in a pretty good position. For us, our apartments are anywhere from $1,000 to $1,500 for call it 1s and 3 bedrooms. So if you look at this and you look at the amount of unemployment benefits that were paid out, you're still at around 3 times your rent for that type of apartment level. If you look at the, that $1,000 number in the 5th column down. So, based on this, we really considered investing even more in this asset class. The government money, in my opinion, regardless of the election, for some sort of stimulus, is never going to go away. They're always going to be, liquid. And obviously we saw that, in April throughout May and June. But it goes back to the fundamental question, is that we got to build more just to keep up with demand. So the number was 328,000 from the NAAA. The annual completions for new construction, it's very hard for new construction to keep up with the affordable apartment renter profile within these income brackets, let's just say. And it's just going to be exacerbated, like I said before. And obviously the amount of households paying more than 30% on housing is just growing more and more, and it's grown that way since 2005. And that could be a result of inflation, and also depending upon where they live. So nationally, what we're looking at is that there are 40 million apartment residents, 21 million apartment homes. But, the real opportunity that, we see in the workforce segment is obviously existing product built before 1980, which, when we're looking at properties, we're always looking to, renovate and expand, whether that's adding additional units or developing on a pad site that's, on the property to build more apartments, as long as you can get the property for the right basis. You're obviously contributing to the amount of, apartments that are going to be needed just to keep up with the demand, based upon these, income levels that we're seeing. That's probably going to be, flat, at least for the next year, depending upon how quickly we rebound from the crisis. So, that was the estimate from the NAAA, about 330,000. And as you can see, a lot of the housing stock is actually concentrated a lot in different areas. So if you look at, supply restrictions in, the markets I have pointed in purple here, New York City, Philly, very difficult to build apartments in those areas that contribute to the affordability factor. As you can see, there's some more areas that are friendly, Columbus, Pittsburgh, Cleveland. There's a lot of new construction going on there. And obviously, the development costs are going up, as well, due to, a lot of different factors. But again, like I said, the situation is just going to worsen, because it's going to get to a point where the buildings are going to become, you have half the country, the product was built before 1980. So those buildings are going to become obsolete. So they're going to start, being converted, or potential, the optimally would be repositioned and renovated, which is what my company does. So, that's going to contribute to the problem. But if you can address it earlier, the better. The markets with the highest proportion that we see are definitely the Northeast, built before the 1980s. As you can kind of see from this, it's mostly the Northeast, and then on the West Coast as well. Either way, we still see there's issues there. Basically, you're looking at the entire country. In the best case scenario, 35% is, built before 1980, and at some point they're going to become obsolete. Obviously, this takes into account, population projections as well. We also look a little bit about immigration as well, the forecast there moving into 2030, how that will be trending upwards as well, and there'll be a need for, affordable workforce housing. And if you look at the distribution of rental housing stock, you could kind of see that, a lot, 65% of it is in multifamily housing. It's actually interesting to see this chart again. I haven't looked at it in a while, but majority of people rent from apartment buildings, which, majority of that looks like it's in the 10 to 50 or more units range. So either way, that 5+ units needed is, on a base case scenario, is going to be trending upwards, throughout 2030. And, kind of the issues that, that I saw, I kind of talk about markets like New York. There's a lot of, there's still going to be population increasing, even if it's marginal. If you look at a city like New York with, I forget how many million people it has now, but even if you get 0.01%, you're still going to be having to accommodate for that need of increase in population. So there's still going to be a need for it in the gateway markets. In other secondary, Orlando, You know, there's definitely a population growth there, even more than the gateway markets, you know, contributing to the increase in demand. So, you know, what we're looking at here is just a slew of, you know, different issues. At the bottom, you see a tab. The metro markets are facing a lot of different challenges, like New York. And mostly it's, you know, affordability, and that, you know, number being north of 30% now spending on rent. So, you know, there's a lot of different issues. It could be state by state level. You know, I talk about, they kind of break it down by states. About 100,000 of those are needed in the gateway markets, including, you know, Florida, North Carolina. And, you know, there's a large population growth moving, you know, the 65 plus age group moving to, you know, warmer climates, you know, in Florida, et cetera. And, you know, there's going to be more senior citizens there as average. So that's going to be another segment of the, you know, affordable housing situation, just because some of, you know, senior citizens, some of them do collect Social Security, you know, different types of benefits that won't be able to support, you know, a very, you know, expensive apartment. But, you know, when we're talking about propensity to rent, and, you know, it depends on what area you're in. You know, we're seeing a lot of demand from 35 plus year olds, at least at our properties. I'm seeing most, you know, it's mostly a middle, I wouldn't call that middle aged, but, you know, it's as opposed to, I was getting a lot of people in their 20s before. I think the COVID kind of contributed to people staying at home longer, especially in that 20s bracket, if they can wait it out a year, and then they'll start to rent again. So I'm seeing a lot of 35-year-olds, 30 to 35 to 40 rent in the affordable segment. And, you know, it seems like, you know, we're always in a credit cycle, you know, where we kind of are, you know, obviously before the COVID crisis, this is kind of the steps that I saw the economy moving into prosperity, you know, the highest stock market record back in, you know, February. We're getting pretty close to where it was before. People are very liquid, you know, providers of capital. And then all of a sudden, you know, as the crisis starts, you know, you know, that influx causes more lenders to be discouraged. The risk averse rises. They become starved. So, you know, where we are in the cycle, you know, I couldn't, you know, really say. I think we're still in somewhat of in the six range here, just because there are, you know, there was an interest rate cut. They are starting to, you know, lower the credit standards a little bit more. They are providing a little bit more loan to value. They're easing the restrictions. So we'll see how this, you know, all plays out. But when we're talking about from a value perspective too, if you kind of look at this chart, this is an example I got from somebody in Dallas. When you're looking at, you know, I kind of classified these on a price per unit basis. And, you know, if you notice from 2000, let's see, 2008, 2009, 2010, if you look at, you know, where you were in the workforce, especially in the lower end, you know, it never really went down in value, although it kind of had its spikes, ups and downs. You're still, your basis was always pretty good. You know, if you kind of look at the 2007 numbers, you know, the average per unit, this was in Dallas again, you know, went up pretty significantly to where we are now. But as you see, the ones that take the most hit are, you know, the top of the market here, the discretionary and upper mid range, and you could kind of see how brutal it got hit in the recession, and it did recover, but they're the first to get hit for sure. So I mean, you know, the way you could look at things is just, you know, definitely, you know, partner with the firm to kind of understand the asset's intrinsic value, just to recognize when it's below market, when, you know, and that could be a variety of factors, whether it's rents below market, operational inefficiencies, et cetera. But that's kind of where I think we're at Obviously, the coronavirus is impacting the economy. The travel tourism we talked about, short-term rentals are being hit. But right now the multifamily, it's still a little bit uncertain, especially with the election. But there's still, as I talked about, all those underlining factors that kind of help promote this optimism that everybody's going to be okay and we're going to get through this. So with that being said, that was 30 minutes. That was perfect. So we'll open it up for a discussion now.
Yeah, thanks, Anthony. That was great. That was really useful information. So if you guys can put your questions on the chat, or if you want to speak up, that's okay as well. And yeah, so if you do write them down, I'm going to relay them over, and Anthony is going to see them himself as well. So
Definitely. Or if anybody, I guess they can raise their hand too if they have a question, and I can answer it. Anybody have anything? I don't think I see anything on here.
Hey, Anthony, I got a question for you. You let me know if this is kind of out of scope, but just kind of curious in your opinion. You talked about a lot of people. They're kind of dropping below the poverty line. There's not a lot of affordability for them. Would you ever consider moving kind of lower down on the scale to Section 8 housing with your multifamily?
Yeah, so that's a good question. Section 8 housing is a very, in my opinion, it's a political risk that you take. In my opinion, I don't think Section 8 is going anywhere. However, I think that depending upon what happens in the next month or so, and over the next year, there's always going to be a need for it. But it's the amount of Section 8. So I know people who have 100% Section 8 buildings, and they love just getting, they have HAP contracts. They do basically are their own Section 8, and they think it's great. But at some point, it's really dependent upon if state or federal funds at that level donated to that program, not donated, but from the taxpayers, if that ever dries up. So that's the risk that you take. And obviously it's not going to dry up, but there could be a cut in the Section 8 housing. I haven't seen it yet. The way that I like to look at things is it's always good to have, if you're buying the workforce product, it's always good to have a mix of Section 8 tenants. I'd say no more than 25%. That's kind of where I like to keep it, although you can't really obviously discriminate. And I do think it's interesting. I see a lot of people gravitating towards the mobile home park space now. I was listening to a guy today that basically said that's definitely more of a long-term game. There's not as much hyper rent growth right now with that, and that obviously will help towards the people who are under the poverty line, or are about to be under the poverty line. But I think the answer is I don't think anybody knows yet exactly. But those are the estimates that I got from the NAA, and seems to be if based on everything I'm reading somewhat accurate. But yeah, there's a lot of ways to help the affordability crisis. And Section 8 is one of them. So I hope that answers your question.
Yeah, I did. I appreciate the added color.
Cool.
Question on the size of the properties, right? So you go through all the data that you presented to make the case. Do you find areas of softness or areas of strength in different size investments? So if you're looking at something that's say a 5 to 10 unit versus 50 to 100 versus something that's say 250 or greater, right? Do you find differences in valuations, differences in opportunities given the size of the targets?
Yeah, it comes down to risk-adjusted returns. I think that definitely on the lower from an investor standpoint on the the 10 units or so, it could be from a return standpoint, it could be better than the larger units. It could be. I'm not saying it is, but I think that especially right now, I think the smaller properties, thankfully we're doing, at least we have some smaller properties as well in that size range. Collection wise, we're doing pretty well. But if you kind of think about it, let's just say, you have one tenant that doesn't pay. Let's say the eviction moratorium gets extended all of 2021. I'm just putting it out there. And you have one tenant in your 10 unit. Yeah, let's say you have two tenants in your 10 unit that's taking advantage of it the whole year. And there's nothing that's done about it. You have 80% collections. So that's we always, from an investment standpoint, if we could do the bigger, the better. But, from the affordability crisis standpoint, first of all, I'm only giving statistics for apartments. For, single family homes is a completely different story as well. So, that's a whole different crisis, and affordability crisis in itself. So, that the stock that's being built, especially in order to have that economies of scale and get your labor prices down and your construction prices down, yeah, they have to be larger apartment complexes, or else the developer is not going to be able to do it. And I've been seeing a lot of light tech deals. If I'm sure some of you are familiar with that, low income housing tax credit deals. I'm seeing a lot of HAP deals, which is basically a Section 8 type of structure for new construction, where they give tax incentives, potentially a pilot program. I'm seeing a lot of that starting to emerge, and financing being very available for that because of the affordability crisis. So hope that answers your question, Mike.
It does. Thank you.
All right. So we have some questions on the chat, Anthony.
All right. So Greg, Florida. Okay. Yeah. And I could explain a little bit about Florida. And I had, so we're looking a little bit for just moving forward. There's definitely stable markets, right? So, there are a lot of cities that I consider volatile, like New York, maybe LA, San Francisco, politically wise and just, price wise. There's so much swings in the prices. So what we're trying to do moving forward, and we've been doing this anyway, is invest in areas with population growth, with migration. And there's a lot of submarkets, you mentioned Florida, Greg, that we're looking into right now, which, is some areas of Florida has been seeing, just during the COVID pandemic, some areas of Florida has noticed like a 4 or 5% population growth, the specific submarkets. That's a lot. So I don't know how, if that's going to continue. I think it will, to be honest with you. But, I know guys who've invested in, every single state, and, it always, the best returns have always kind of come down to, at the end of the day, if it's a value add project in the Southeast. So I think, I think, the criteria we're looking for is very similar to, the standard workforce housing criteria that we've always stuck by. But we're trying to stay away from areas with population reduction, moving forward. But you have to stay open-minded. There's a ton of markets I'm sure people are, looking at, and just really understand where you're investing. I'd say market like Arizona is pretty volatile. There's a lot of appreciation, during the upcycle, but, during the downturn, I looked at some downturn statistics. It goes down pretty heavily. And that it might be because of an industry concentration there. Same thing with Houston. But, it's going to come down to the fundamentals. It's going to come down to some micro fundamentals too, like, statewide eviction moratoriums and landlord friendly states versus tenant friendly states. So hope that helps answer the question.
Yeah, thanks.
All right. Evelyn, you mentioned you're heavily invested in Class B and C. What are your collection rates? Do I use management companies, and what do I pay them in terms of collected income? So the collection rates, as I showed in the slide before, I think the national was like 89 in April. So since April, we've been like 93% plus. I think our best month was, I think it was July. I think it was like 97, 98%, but that's when I think the stimulus payments came out. It was like maybe towards the end of June, and a lot of people used it for July. The September collections were really good as well. It was like 94%. So we've always been in that 90s range, which is great. In terms of management companies, yes, we do. We run our own management company. So some properties, it depends upon how big the property is. What percentage do you pay in terms of collected income? If we were to hire a third party, we would pay anywhere from 3 to 5%, depending upon how big the property is. If it's like 50 units and up, then probably, in that 4 to 5% range. If it's less, obviously it goes higher. And more units, it goes lower. So that's generally what we're looking at.
So I actually have a question. So I saw a lecture very recent one by Neil Bao, where he compared, so there was the vacancy suburban, sort of a definition of suburban. So, and vacancy rates there versus the city areas. And so it was actually the first time reversal in 30 years of suburban vacancies, being better, than city areas. And it's actually has given me the impression that you, primarily specifically in the Northeast, you actually don't target so much cities, because usually syndicators, they tend to pick city areas, and like they have a list of cities that they invest nationwide, etc. And it's a very different approach for you, because you have Morris County in New Jersey, you have Sussex County, right? And those are very suburban areas. So how has that, do you have any observations on that? And specifically in the Northeast, what are some areas that you're already seeing maybe the beginnings of like a positive trend, maybe like increased by COVID, etc.?
Yeah, and like I said before, I mean, COVID just exacerbated the cities to suburb migration.
Yeah.
And again, I think it comes down to, like, for example, I would never invest in New York City in the first place. People look at me with 10 heads sometimes because they made a lot of money in the city. But we've always stayed away from areas that are not, somewhat landlord friendly. And by that meaning having very strict rent control, taking potentially up to a year to evict a tenant. Those things can really hurt your bottom line. So we try to stay away from that from the beginning, even though we're based out of the Northeast, and we're pretty close to New York City. For me, I've always kind of saw some migration to the suburbs because of, I talk about the affordability factor too. And that's a huge component of it, because I don't want to be investing in a $4,000, 600 square foot apartment in Midtown Manhattan, where, the vacancy rates in Midtown, I think John, he just came on, he posted an article in our Facebook group. I think it soared up to 23% just in the month of September alone. And rents have also dropped by 10%. So just think about it. Think about how many people who invest in the city who might have been over leveraged that, can't make their mortgage payments right now because they have vacancy and the rents have gone down. They've been offering like a month free and 2 months free in some places. And I'm not just saying that because I saw it on the news. I personally know people who moved out within the past 2 weeks. So it is real. Do I think the cities will come back? Yes. That's going to take a long time. I don't know how long. I could be wrong. But, it comes down to our leaders, in my opinion. But we'll see what happens.
Sounds good.
Hi, I have a question.
John can go, and then Constantine.
Okay, so my question is very, very hypothetical here. Just thinking about in terms of you talking about the bottom line, and I'm thinking, let's say I have a property that have 10 units and I purchased that property for $1 million. Considering the interest, the mortgage, the taxes, the insurance, the vacancy, the property management, the maintenance, what do you think I can expect to have as a cash flow, positive cash flow? Again, I know this is very hypothetical and broad question. Thank you.
So what would you expect in terms of cash flow if you purchased a 10-unit building? Or
Yes.
what? I'd have to. It's very subjective. I've had to look at the building. I have to look at the numbers.
What would you say is a good cash flow to expect from a property like that?
I mean, the rule of thumb is if you can outbeat the stock market, then it's a good buy. But also you got to think about, all the depreciation benefits you're going to get from an after-tax perspective too. That'll add up over time. So that's generally what I tell people. If you can beat the stock market, then it's a good deal. And the way I think about it is the 8 to 10%. So.
And so I don't know if you've read a lot of the articles. Like, do you subscribe to CoStar and stuff like that? So there's like these articles every month, basically, from economists who claim the whole time, like, without the stimulus checks or the additional $300, $600, whatever it was, in the stimulus checks, once that runs out in the end of July, right? Like, collections are going to go down dramatically. And basically at work, what I've seen and from following you, what I've heard is it's actually been the opposite, where for some reason lately, like September is better than what we've had beforehand. So I guess I just want to know what your thoughts are on that. Like, basically it's the opposite of what economists have seen has happened. And it's just very strange. Like, how are all these people every week, you see all these unemployment figures coming up. It's like, how are people paying? It's just like always blows my mind when I see that.
Yeah, I mean, I think people are, number one, they're getting back to work, so that obviously they're not dependent upon stimulus or government money at this point. But some people before were making more money on the unemployment than what they're actually making now. So yeah, no, a lot of economists were saying that, and the reason why they were saying that is because, like I said, our best collection month, at least during the crisis for us, it's a little bit different for you guys, was when everybody got the stimulus checks. And I was listening to Neil too, Stefan, and he said that I think it was like 15% of the B and C apartments actually use their stimulus money to pay their rent in that month. It was like 15%. So I guess if you look at it that way, then I mean, in that segment, that means you have 15% unemployment. Technically, and that's not the way you should be looking at it. But if you have 50% unemployment just in that segment, and then you have on top of the other types of unemployment, yeah, theoretically, it should be, the collection should be lower. Like I said, I think just because of there's always a problem in this country with the demand for the apartments and at these price points, and with the figures I showed you, even if they're on unemployment and for whatever, the 35 weeks, the maximum, whatever it is, which is basically almost the whole year to some extent, they could still afford the rent, in the apartments that we target. So that's how I looked at things, and maybe that's contributing to it. But I could tell you personally, in our portfolio, if I had to guess who's unemployed, it's probably 3 to 5% of my portfolio, at least as far as what I'm aware of. And then my portfolio also consists of, in my portfolio, I have about 10% Section 8. So outside of the 10% Section 8, there's maybe another 3 to 5% that maybe got laid off and are not working. But somehow they're still paying their rent. So I can count on one hand how many tenants didn't pay for September, which is not many. So
if I could jump in, I could add a little more color. Just, I mean, I view this from a different lens, working with individuals and families, and outside of real estate. And what I see is people they just don't have anywhere to spend their money, right? So obviously they're going to spend it on their basic needs. They're going to spend it on their shelter. They're going to spend it on food. They're not spending it on clothing. They're not spending on entertainment or travel or, you know, any of these discretionary items, right? There's no discretionary spending. So just by default, people are saving. So even if their earnings have dropped, they're saving because they've got nowhere to spend the money anyway. Because I thought the same thing as you,
that
John.
makes a lot
I
of
thought
sense.
the
I
exact
didn't
same
think
thing.
about that. Yeah, that makes a lot of sense. Thank you.
That's a great point. I would agree. Most people are staying at home, not traveling as much, obviously. You know, in certain areas, especially the Northeast, it's still somewhat locked down. So people aren't eating out as much. Yeah, no. Makes sense. Anybody else have any other questions?
So Anthony, so in your specific like selection criteria, let's say, so you mentioned about beating the stock market and that, but are you looking for a certain value add percentage? So if you're doing a value add deal, do you want it to be like 10%, 20% improvement in the appraisal? Are you trying to kind of take your initial investment out or refinance after a year, things like that?
Yeah, so we look at a lot of factors to determine whether it's a good investment or not. If it's a value add, I mean, you know, we typically buy performing properties already, but it's just undervalued rents and, you know, inflated operating expenses. So we generally like to see at least 10, it's anywhere from 10 to 20% below market, because then I have an idea of whether or not it's going to hit the return criteria that we look for. And obviously it depends upon many different factors, the financing, how much capital improvements you need, et cetera. So there's just so many different factors that play into it. But that's kind of a rule of thumb that we look at least on you know, a stabilized value add property that we're looking to acquire.
Sounds good.
Anybody else have anything while we're still here?
All right, so if you guys have no more questions, we can, we are pretty much approaching our 1 hour.
Yeah. Last chance.
I just want to thank both Stefan and Anthony. This has been great, really helpful, and appreciate your you know, offering your wisdom to us. So thank you.
Thanks, Mike. All right, so thank you so much. Thanks, Anthony. That was really useful, really informative. I
Yeah.
really appreciate it.
Yeah, and if anybody wants the PowerPoint, you know, I went a little fast a couple times. Feel free to reach out to me. I just put my email in the chat. I'm happy to share it with you. There's a lot more in the presentation I kind of not skipped over, but I didn't elaborate on. So happy to send that to you if you need a copy.
Awesome, sounds good. Thank you so much.
Thanks.
Great. Thanks, man.
Thanks again.
everyone.
Thanks.
Bye, everyone.